Welcome, ladies and gentlemen. Today is the 22nd of October. My name is Brad Matheny, and we're going to go over the general markets right now and try to focus on what I believe is going to take place over the next 4 to 6 plus months. So we're looking at a NASDAQ weekly chart with my TT Charger software embedded here. Now I'm going to spread this out and try to show you actually what's going on and try to talk to you about what's coming, I believe. So the Fed is talking about moving to a more accommodative stance, which is being interpreted as a potential Fed pivot. We've seen this very deep low last week with a big turnaround that took place rather suddenly. And what we have here is really an A, B, C, D, E wave pattern down. Now, we could be in the midst of a deeper decline, so I want you to be aware that this entire lower blue area, including this highlighted ellipse right here, could be another downside target for the market if the Fed suddenly blows a hole or something happens to blow a hole in this support level. But ultimately, when you think about it, we're really at an A, B, C, D, E pattern in this downward trend. We've had a broader C pattern here, which I will highlight so you can see how the C pattern is actually the longest wave, which is typically required. A cannot be the longest wave, and E, the last wave, can be the longest wave at times, but should not be typically the longest wave. Wave 5 should be one of the smaller waves. So here we have C, here we have A down to here, and you can see that C is longer. And here we have E, the fifth wave down, and you can see that it is also longer. So meaning that the C wave is also longer than this. So in theory, this C wave here, from roughly here to here, is in structure, Fibonacci structure, quite competent related to this downward move, which means that we have a very strong bottoming formation right in this area. So we have this bottoming formation coming in right in here that may end up being a fairly strong bottom for the markets overall, and it may end up being something that drives real stronger upward trending going forward. And that's where I want you to focus right now, because if we move into a stronger upward trend, a wave 5 trend, as I have been predicting since way back up here near the top, then we are looking at a scenario, as I highlighted earlier, where, and I will get rid of these and try to draw them for you. Oops, I want to put that one back and get rid of this one. There we go. If this is a wave 5 type pattern, and it does originate from this low right down here, then ideally I'm thinking we're going to see some sort of an upward move like this, potentially moving into a wave 1. So again, a 5-wave structure, A slightly above this level here, A, B, C, D, E to wave 1. Then we're going to be at new highs, and we've seen this before back over here, beating around new highs all the way up. Then we're possibly going to see some sort of a rotation that may scare people, and then possibly a flagging formation, as I just drew here, before we potentially, and it may not actually be this long, let me redraw this, and redraw this. So if we were to have a wave 5 bottom here and come up into this range, correction, up into this range, correction, up into this range, then have kind of a flagging formation like this, This would potentially give us a scenario where we have a flag that sets up a very solid pennant formation, kind of like this, that aligns into our peaking pattern. Now, where this peak is here is open for discussion. This wave 5 peak will likely attempt to establish new highs. It could be essentially half the range of this pullback. So we could get all the way back. This is roughly a 1.38 extension. We could get up a little higher. We could end up moving up into the 1.5 extension and then forming a sideways pattern. Or we could come from this level and go all the way up to potentially a 1.68 extension, kind of like this, and forming some sort of a sideways pattern. But ultimately, this is what I believe is going to happen. Now, the downward risk in this area puts our real ultimate downside support level right down here. So I'm going to try to draw a line here, and it's right off of this green level. So you can see right across here. Try to get this somewhat flat, which I didn't do. Getting these lines 100% flat is rather difficult at times, but I'm trying. And turn off the price distance. So we have support here at 10,007. Whoops, come here, mouse. 10,675 roughly. I'll try to spread this out, give you a real number. Call it 10,775, 10,750. And then we have support down here at roughly 8,600, 8,660. Now, where are we in this scenario? I believe that we're looking at essentially a 100% rally. I believe if you take a look here, and it's already here, we're looking at some kind of 100% rally. So we could move to this level, which would be about 119% to the upside, to 10,500 points higher, or potentially up to here, which is 141% to the upside, or potentially up to here, which is about 171% to the upside. And that's where I believe we're actually structuring right now. There's a ton of, let me explain what's going on. There's a ton of money out there. A lot of that money's been pulled away from risk and is now looking to redeploy into undervalued assets. Undervalued assets right now, in my opinion, are metals, foreign markets, foreign currencies, technology, innovation, space, everything that's been beaten down by more than, say, 40 or 50% over the last couple of 8, 10, 12 months. Now, additionally, there's a lot of good companies out there that have seen their prices fall by 20, 30, 40%. A lot of these are large cap companies, dividend producing companies, and they're very likely to be scooped up to some degree on a new wave of buying. And that new wave of buying would be in this area here. This would be the accumulation phase that would take place right here. And this accumulation phase would take place as a shift away from the fear factor. And it's kind of like what happened after COVID. So when you take a look back here at COVID, let me spread this out and try to show you. So here's COVID. Here's our COVID crisis right here. COVID selling, nobody knew what was going on. There was some early buying in over here as the Fed came down. Then we ran into election periods right over here, actually over here. But this was early accumulation. This was when you started to see very early accumulation. We really didn't move into the momentum stage of buying and the carry forward until back over here, almost 8, 10, 12 months later. And it lasted for almost a year, a little over a year. So understand that we're going to get the same type of buying. Same thing happened back over here. We had this base in 2018. We had this early accumulation phase. We didn't start moving into the real expansion phase till we got up into this new high pause, new high pause. Then we started getting into this expansion phase, the price trend before COVID hit. Had COVID not hit, you can see the trajectory that we were at. And that's one of the reasons why that trajectory picked back up after COVID. So when we take a look back over here of where we were at in this setup, this trajectory here, you could almost take and say from this area roughly to say this area as an uptrend. I'm going to try to show you a little bit about how I see this. And you could almost take that same line, duplicate it back over here, and say that we may have a similar type of price action take place going forward. What this is essentially the momentum that we saw here in the post-COVID rally could begin to accelerate here in this post-COVID range. Now remember, this is from the lows over here to approximate highs over here. And this gives you an example of why I drew the first peak right here. This is really, you figure A, B, C, D, E right up to here. This is a 100% measured move, okay? And then we have the 100 and roughly 1.382 measured move. And then we have approximately a 1.5, 150% measured move to the upside. So in reality, if we resume this trend, which may start off a little weaker and then pick back up, we're looking potentially at July, September 2024 as being new highs, nearing a potential peak, possibly seeing some weakness, maybe extending hypothetically from this level, maybe extending another, let me see how far. Maybe extending another 15-20% higher to get up to this level. Okay, now that then moves us into this peaking, this waning formation. And what's going to happen over here, in my opinion, is either this flagging formation that I've shown you, or we're going to get into some sort of a big rounded top before we move down into a excess phase peaking pattern, which will break to the downside eventually back over here. So understand that this is where the bigger, longer term picture comes into play. And it's all predicated on the fact that this is our wave 3 move. This becomes wave 4. Now we have wave 5 that must push higher. So we're looking at another longer wave to the upside, which is going to give us a new high, new eventual all-time highs. And then we look at some crisis event taking place back over here, 2027, 28, 29, maybe 30. And it's going to be an extended crisis event that may roll over. So what we're looking at again, ladies and gentlemen, right now is a shift. To put it simply, what I think is going to happen is Europe is starting to learn its lesson. The Fed is starting to learn a lesson. And the Fed really is going to, as I mentioned, they've got their back against the wall. They can't collapse the global market. It's going to be too risky. They want to navigate inflation, but in order to navigate inflation, they're going to have to do so by dancing around the risks that are occurring. So they're more than likely going to move into an area to try to deflate asset prices, houses and demand, energy, possibly even food coming down. They may put some extra pressure on global markets, but they're probably going to move towards a wait and see type of mode near December, trying not to disrupt the markets, moving into a Q1 scenario, trying to keep the U.S. economy afloat, trying to deflate real estate, deflate food, deflate energy. And that's why, like I said, I think we're kind of nearing a bottom. And I believe that really the next 2 or 3 months, we could see a good solid Christmas rally up into this area, maybe even higher if we start to get some real momentum. But then Q1 2023 is where we need to see if that momentum continues higher. and how high it's actually going to go. So let's take a look over here at the ES. And remember, the TT charger is reflecting the downward cycle trend. So when we come in here and we take a look at these downward cycle trends, you can see that we have been short since way over here. This is February 2022. Okay, we went into this short-term trending with these red diamonds up here. We've been short-term trending here. The next move for the ES, let me get rid of these lines. Well, actually, I'll leave them, but the next move for the ES off of this low, and this was a critical low, is going to be to come back up here to these levels, to this stop level right up here. Okay, so that is an 800-point move, 820-point move to the upside for the ES. Let me get the percentage levels. Say, can't see it because of that thing there, so let's move it. 23% move to the upside. Big. That's a really big move to the upside. But then again, understand that it's got to get above this. It can't just come to this level. It's actually got to get above it. So if that's the case and it moves back up to these levels, you are talking a 30 to 33% upside move in the S&P, which is really big. And that's assuming this support level, which goes all the way back to our our 2010, 11, 12 peaks. There it is. Got a little too far. Hold on. These peaks right across here create that dashed green line. And it's almost uncanny how that line acted as support for this bottom last week and prompted this big reversal. If the next move is correct, it's going to move, the S&P is going to move back up to 4,600, 45.80. First, it's going to run into resistance right in this area at around 33.20 to 41.80, roughly 41.75. But ultimately, ladies and gentlemen, what you're looking at is a rally in the S&P starting wave 5, which is going to potentially terminate maybe somewhere up in this 54.50 area, maybe potentially up in the early 6,000, call it 6,050, 6,100, or potentially back down in this area, which would be a moderate rally at around 52, 52.50. But ultimately, ladies and gentlemen, we're looking at about a 45 to 50% rally if my assumption stays correct. And remember, we still have that 2027, 28. Let me try to find it for you. 26. There it is. So here's our ultimate peaking pattern, way back over here. So when you get right down to it, if you were to start asking me when I think the wheels are going to start falling off the train, this is the approximate window that I think we could see some sort of wheel falling off the train. And ultimately, we could see the S&P up as high as 7,400 if it's as big, wave 5 is as big as wave 3, but understand that that's not likely to be the case. So if we take from current lows up to what I think might be an ultimate peak, and let me go the other way. So we take from these levels here and come down to these levels here. What we are looking at, ladies and gentlemen, is 6185 and 382. So we're looking at these levels here as potential peaking levels. From here to here would be an initial peaking level. Roughly from here to here would be a secondary peaking level. And from here to here, get my mouse to cooperate. I was almost there. All right, close enough. Would be a third peaking level, meaning that we could see any of these levels right in this area indicate ultimate support before we get into some sort of extended flagging. What that could mean is we could see a rally from this level up to here, down to here, up to here, down to here, and then up eventually to some area up here before flagging and breaking downward. And that's ultimately what I believe is going to happen. Now, how this is going to play out, I don't know exactly how the levels are going to play out. What I do know is that my cycle pattern research, my Elliott wave research is telling me that we don't have any major cycle events until we get into this area, right in here. So that means we're likely to see, in my opinion, some upward trending, some maybe, as everyone's calling this, the everything bubble. Maybe we have another 4 or 5 years of everything bubble to go that no one is considering. Everybody is now calling this the peak, that the Fed has run themselves into the ground, and this is the end of all ends, and it's going to collapse. Maybe everyone's thinking this area here is the end of the end, and this is the blasted collapse of all collapses. Okay, maybe. And until I see that we're below these levels here, and particularly below these COVID levels, it's very difficult for me to see this because I don't believe anybody would actively move in this scenario. It's just too easy to wipe out debt, to run some sort of an orderly debt default, and then move us into a right direction. Now, this becomes much more complicated. This requires a lot of central bank planning, a lot of quantitative easing, a lot of potential growth, potentially money printing, and eventually we could see some sort of a massive pullback up here after this huge wave. Because remember, in this area here, if you really take a look at from the 2008, 9, 10, and yeah, I'm going to cram this in here. So we have this big hyperbolic, parabolic, let's call it, phase that comes across here and really starts moving vertical. I mean, if we were to come here to monthly, the parabolic phase becomes much more evident. You can see it here. So see this parabolic phase, this line right here, try to pick a different color. Let's make it bright pink. You can see how this parabolic phase comes into play. And again, that's what I honest to God believe is going to happen. You can see my counts here. So we have really an A, and then we have a pullback, and then we have an A, B, C to 3, which is where we are at the peak of 2021. Then we have 4. Then we likely have an A, B, C, maybe up into this area or higher, up into maybe this area, which is going to be our ultimate peak. Okay, and then we start to move downward. And then remember, ladies and gentlemen, this level right here, this green level, still becomes major support. And this channeling cycle right here also becomes major support. So we've got a bunch of support levels right over in this area that we're going to have to dance and contend with. The ultimate peak may end up being nothing more than some sort of a pullback from here to here, or here, or here, or down to here. And now granted, that's a pretty big pullback. That's a, if I were to take a look here, this is going to be probably a minus 60% pullback, which can happen. There we go. Minus 37% from up here. So I got to do the math. Yeah, that'd be right. From 7,500 down to 4,500, that'd be a minus 37% pullback. A same type of collapse, a 60% pullback, where happened in 2008, 2009, would be something down in this area, back to the COVID lows. You see how that lines up across this area here, the COVID lows. So understand that we really are at one of the most important times for you to consider what's going to happen. My research says we're going into wave 5. My research says the Fed is going to pivot. My research says we're not anywhere near the all-time highs of the market, and gold and silver will likely react here just like it did back over here in 2008, 2009, which is that, remember, gold was trading at about $300 an ounce back over here, and then it rolled actually it's about $700 an ounce over here, and rolled up to, by this time right here, rolled up to about $2,000 an ounce. Now, gold right here is trading about $1,600 an ounce, $1,700 an ounce. And by the time I think we're going to get out to here, I think we're going to be at $4,500 an ounce or more. By here, who knows? But the next phase, through this cycle phase, gold, in fact, let me add gold here. No, I'll have to do that later. I think that we're looking at one of the most critical times for traders and investors right now on the planet. If my research is correct, then we are going to enter a new phase that no one is prepared for, and this is going to be non-existent. But this phase is going to become very, very critical, and this is only 3 or 4 years away. We start getting to it. So we need to prepare for this. We need to get ready to start adopting a wave 5 rally, and then we will deal with the end of wave collapse and what happens next. And this could be very, very dangerous. This could be massive, or it could be just an end of cycle wave collapse, like I was trying to show you, about a 35% collapse. It could be nothing. Try to get this again. It could be nothing in terms of, if we move back down to like this level, 29% collapse. It's bigger than what we have right here, but it's going to be felt by everyone, but it's not the 60, 61, 62% collapse that we had like during the global financial crisis. It would take a massive collapse of global economy or population or nuclear war to do something like that, in my opinion. All right, guys, I'm trying to prepare you for what's next. I really want to have some sort of a video or written record of this, because there's so much doom and gloom out there, and I want everyone to be able to see what I'm predicting, what I think is going to happen. And remember, I'm doing this now. It's 2022 right now, and I'm predicting all the way out to 2027, 28, 29, 30. So we'll see how it plays out. Either I'm going to be right or I'm going to be wrong, but either way, I'm putting it out there so that if something happens to me, you guys know what to expect going forward, at least as of right now, October 22nd, 2022. All right, guys, that's it for now.